Keith Fitz joins us this Monday morning. All right, Keith, COVID is raging and the markets are rallying. Why don't you explain that?
Because people want to get out. Omicron and COVID is going to fade into the rearview mirror relatively quickly. We're learning to deal with it. The best companies are plowing ahead. Tesla's a great example, almost put out 1 million vehicles last year, despite Omicron, despite COVID, despite chip shortages, despite manufacturing problems. They are but one of 50 or 60 companies out there that's really going to make a difference in our world.
Now, this surge of COVID, Omicron, I mean, it could slow the economy a little. How will the Fed respond to that?
You know, that's an interesting question because I think the Fed has been out to lunch somewhere for virtually the entire crisis. I think the fear is that the Fed is going to clamp down and they're going to take away all of the punch at the punch bowl. But the reality of the situation is they're going to hike rates Q1. I think that the market's going to have a knee-jerk reaction, that we're going to be right into earnings. We're going to be right back to some great numbers, and we're going to move forward.
Could the slowing economy affect the inflation rate and therefore the stock market?
You know, in the past, Stuart, I believe that could have been the case, but now I think the statistics are so hopelessly cooked and messed up that I don't think so. I think the official government inflation is going to differ radically from what we actually feel in our wallets. And for that reason, again, I think the Fed completely lost the narrative. It's going to go down. The transitory thing is going to go down as one of the worst possible calls in recorded federal history, maybe even financial history. So I don't place a lot of, a lot of importance in the Fed's numbers as official inflation statistics go. I'm going to watch what people actually do with their money. The consumer spend is the far more important number here.
So to you, Keith, the big deal here is the spike in COVID, which may soon be winding down so we can see the other side and not exactly get back to normal, but put it in the rearview mirror. That, to you, is the overriding factor in the market today. Is that correct?
It is, because again, we're learning to live with this. People want to be out. We're filled with hope and resilience. We've got more computing power and more smart people working on this than at any other time in human history. We will beat this, just like we've beaten other great challenges in human history. The peaks always precede a healing period or a moving away period, and that's where I think we are going right now.
Maybe investors are in a good mood, but I think the country as a whole is rather sour. A sour mood coming out of the holidays as they were disrupted. What do you say?
I would share that sentiment. And, that to me is deeply saddening because America, this is not the America I know. The America I know is filled with smiling, happy, hopeful, aspirational people. And to feel the psychological overweight of this, to be 3 years into the crisis, to not have rapid testing, to not have this under control, it's wearing on people, including me. I mean, even my family we're very, very frustrated. We are about as optimistic as you can find. So to me, that is a disjointed piece, and it's unfortunate.
It is indeed. Keith, Happy New Year to you, if I can say that, following my comments about the sour mood of the country. It's great to have you
Happy New Year, Stuart.
We'll see you again real soon, Keith. Thanks very much indeed.
Thank you.
30 seconds.
Hi, it's Keith here. Thanks for checking out today's highlight clip. What'd you think? Did I make sense? Is there something you'd like to add? Make sure you leave a comment down below, and of course, click subscribe to keep up right here on YouTube, or sign up for the email newsletter at the link below. You can also find me on Twitter and Instagram for my real-time thoughts on markets, analysis, and a whole lot more.